Have you ever wondered how legendary investors like Warren Buffett spot a great deal? Well, today, we're going to pull back the curtain. We are taking a company you definitely know, HP, and we're going to run it through a classic value investing checklist to see what we find.
I mean, that's the big question, isn't it? It's not about chasing the hottest new thing. It's about finding a genuinely great business that, for whatever reason, the market just isn't appreciating right now. Think of it like a treasure hunt. And we've got the map. All right, so our X on the map today is HP. Yep, that HP, a name everyone recognizes. But could it be a hidden gem? We're going to find out using a simple but really powerful step-by-step checklist. Let's get started. Okay, first things first. And this is really important. We're not even going to look at the stock price yet. Before we do anything else, we have to ask a fundamental question. Is this actually a good business? Is it a solid, profitable company? So our first tool for this is called Return on Invested Capital, or ROIC. It basically answers a really simple question. For every single dollar the company invests in itself, in factories and technology, how much profit does it spit out the other side? It's a fantastic way to measure just how good a company is at making money. And look at that. HP comes in at 18.64%. Now, to put that in perspective, anything over, say, 15% is usually seen as really, really strong. So this tells us that fundamentally, HP is excellent at turning its investments into cold, hard profit. So, check number one, the business looks pretty healthy. But while we're on the health of the business, I want to show you a number that, at first glance, looks broken. The price-to-book ratio is -24. Now, normally, seeing a negative number here would send up some serious red flags. So what's going on? Well, this usually happens for one big reason. The company has been buying back a ton of its own stock. See, when a company uses its cash to buy and retire its own shares, it can actually push the accounting value of its equity into negative territory. Far from being a red flag, for a value investor, this can be a huge positive sign. It means management thinks their own stock is a bargain. Okay, so we've got a healthy, profitable business. Management seems to think the stock is cheap. Now it's time for the second, and maybe the most crucial part of our checklist. Are we getting a fair price? This is where the real bargain hunting begins. Our first stop is the classic price-to-earnings ratio, the PE. Think of it like a price tag. It tells you how much you're paying for every $1 of the company's profit. Simple enough, right? And generally, a lower number is what we're looking for. And right here, we might have something interesting. HP's current PE is just 7.63, but look at its average over the last 3 years. It's been almost 10. So just based on its own recent history, the stock looks like it's on sale. Now, earnings are one thing, but a lot of the pros, Buffett included, really like to follow the cash. Cash can't be easily manipulated with accounting tricks, so we look at the price-to-free cash flow ratio. This compares the stock price to the actual, real cash the business has left over. And guess what? We see the same story. The current ratio is 6.52, and that's well below its 3-year average of 8.56. So both of our main valuation tools are basically shouting the same thing. This stock looks cheap compared to its recent past. So we've got a good business. Check. It looks like it's trading at a bargain price. Check. But what's in it for us as the owners? How does the company actually reward the people who put their capital into it? That's part 3 of our checklist. And boom, right off the bat, this number just jumps off the page. A dividend yield of almost 6%. That is a direct cash payment right into your pocket just for owning the stock. In today's market, a yield that high is pretty incredible. But here's the thing. A high yield is great, but a growing yield is even better. And look at this. Over the last 5 years, HP has been increasing that dividend at an average clip of over 9% per year. That shows a real commitment to returning more and more cash to shareholders over time. And if you want the ultimate proof of reliability, here it is. 15 consecutive years of raising the dividend. Think about that. Through recessions, through market ups and downs. For 15 years straight, this company has given its owners a raise. That's the kind of consistency we love to see. All right, let's pull this all together. We've got what looks like a healthy business. It seems to be trading at a really attractive price. And it rewards its shareholders generously and consistently. Now it's time to bring it all home with the final, most important test of all. We've collected all the clues. We've looked at the evidence. So what does it all mean? What's the single most important idea in all of value investing? And what does it tell us about HP right now? It all comes down to this one phrase, margin of safety. This is the absolute foundation of everything Buffett and other great investors do. It's just the difference between what a company is actually worth, its real intrinsic value, and the price you pay for it on the stock market. It's your safety net, it's your discount coupon.
So here are the two numbers that matter most right now. The price tag on the stock was recently about $20, but based on an analysis of its future cash flows, its estimated fair value is over $42. You don't have to be a math genius to see the massive gap between the price and the potential value. And that gap gives us this incredible number, a margin of safety of over 52%. Let me put that another way. This suggests you could be buying this asset for about half of what it might actually be worth. That is a huge, huge discount. And that buffer, that's the whole ballgame. Finding a good company is great, but finding a good company when it's on a 50% off sale, that's the dream of a value investor. It's how you try to put the odds squarely in your favor. And that really brings us to our final thought for today. Of course, no investment is ever a 100% guarantee. So does a massive margin of safety mean you can't lose? Or is it more about building a process that tilts the probabilities so heavily in your favor that over the long haul, you give yourself the best possible chance to win? That's something every investor has to think about.